Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello and welcome to another episode of InvesTips. I'm your host, Steve Brice, and today we're going to discuss the topic of portfolio rebalancing. Joining me today is Trang Nguyen, a senior portfolio manager from our discretionary portfolio management team. Trang, how are you doing today?
I'm doing great. Thank you for having me today, Steve. Very excited to be discussing about the importance of rebalancing.
Absolutely. So let's get started with the basics. Can you explain to our listeners what exactly rebalancing means in the context of an investment portfolio?
Of course, rebalancing is a process of buying and selling portion of your portfolios to adjust the allocation back to the intended percentages so that investors do not take on more risk than they can tolerate. Now, this is extremely important because for any portfolio, the risk and return profile is defined by the mix of investment it has. Over time, some investments perform better than others, and their relative weights tend to drift away from the initial allocation. Now, in fact, more often than not, clients tend to end up with a portfolio that has more exposure to risk asset than they should have over time.
Okay, so basically rebalancing is a risk management tool.
That is absolutely right.
But some people might argue that why would you want to sell something that is doing so well? Why are you not afraid of rebalancing too early and missing out on some of the gains?
Very good point, Steve. I think, yes, sometimes rebalancing can lead to missing out on some of the short-term gains. But over the long term, periodic rebalancing has proven to be beneficial to investors. This is because, first of all, as you know, it is nearly impossible to time the market consistently. Not to mention, our analysis show that when you can consistently lock in the gains from selling assets that have done well and reinvest them into the assets that underperforming, hence are being cheap, your portfolio return actually improves significantly over the long term.
Okay, so consistency is really key here. Rebalancing can help simplify many investment decisions, especially during volatile times when emotions can cloud our judgment. Now let's talk about how we can go about rebalancing. I guess there's two common methods. So the first is calendar-based, in which investors choose between different frequencies. The common ones here are monthly, quarterly, and annually. And the second method is threshold-based, where investors set a threshold of how much they allow the weights of key asset classes to fluctuate and only rebalance if those thresholds are breached. So I guess my question for you is, if these methods are so simple and straightforward, why doesn't every investor do this consistently over time?
Well, your question is spot on. I think there are two main reasons why not everyone managed to do rebalancing consistently over the long term. Now, first and foremost, it does take a lot of discipline to simply stick with the plan, especially during the time of uncertainties. For example, if an investor expects a recession might come soon, but not sure whether we have seen the bottom yet, rebalancing can be a difficult question to answer. And perhaps you can share your thought as well. But at this point, many investors wonder if it is actually a smart decision to sell bonds or safe haven asset to buy into equities.
So I guess if this is for the foundation allocation of your overall investment and you're not sure that you can time the markets or call the recession, the key is to focus on your long-term objectives. And then in that situation, maybe the answer should be yes. We should take advantage of any huge sell-off in equities to rebalance into equities, especially if your portfolio is underexposed to equities at the time. Over the long term, this should be beneficial for portfolio returns.
Yes, I completely agree with you. Now, our analysis also show that in this scenario, the choice of frequency and threshold to use during rebalancing would matter more. I did mention there are two reasons. So the other reason that prevent people from committing to regular rebalancing is actually the amount of work required. Imagine you have to buy and sell on multiple security with different trading costs, not to mention that nowadays, many of us actually hold investment with different broker in different platforms.
Okay, so that's absolutely right? So it sounds like a lot of work. So what should we do?
Well, for investors that have time constraint or simply do not want to do the work themselves, I think they can consider using a multi-asset global diversified portfolio to build a foundation for their overall investment. Because with these type of solutions, investors can save a lot of time. And more importantly, they can rest assured that rebalancing will be done systematically, consistently, and at very minimal cost and effort. Now, it sounds like a very simple suggestion, but in my opinion, it actually is a very crucial factor to the success of any long-term investment plan.
Well, thanks, Trang, for sharing your insights. I found it very useful. With that, thank you for listening, and I look forward to talking to you again soon. As always, if you'd like to follow our market views on an ongoing basis, please listen to our Cut to the Chase or weekly Through the Noise podcast series on this channel. Alternatively, you can go to Standard Chartered Wealth Insights on LinkedIn or Facebook. And with that, we'll call it a day, and I hope you are well. Take care.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.